GameStop's shares are climbing once again following its roller coaster week on the stock market. Free trading stock pioneer Robinhood reversed its decision to restrict all sales for the video game retailer on its app today. It comes after an outcry among company investors and politicians alike. The company claims it paused trading on GameStop in order to protect its users. The day-long freeze caused GameStop's share price to fall dramatically and prevented individual investors from buying shares of the stock. Although it has since rebounded, the decision raised concerns over who has the right to control access to the stock market and how investors choose to spend their money. For more on this, Andrew Smith joins me now. He's the chief investment strategist at Delos Capital Advisors. Andrew, welcome. Great to have you with us. First off, before we get into the GameStop situation, a little bit about short selling in general, because when it comes to short selling stock, the practice has been criticized in the past because essentially it's a bet against a company's growth. But that being said, short selling has been used by hedge fund investors for decades and is now largely recognized as part of keeping the market efficient, correct?
That is correct. It's a very slippery slope here because short sellers have served a pretty unique purpose within market efficiencies and market dynamics. The best case in point is the Enron scandal that we saw back in the 90s and early 2000s. It really was a short seller hedge fund or analyst that came out that saw what was going on with that company that helped the market realize corporate fraud was ebullient. What's happened, though, is that we've got a number of hedge funds that have come out that all they do participate is in the short selling game, and that's caused a little bit of a market dynamic shift to where sometimes that seems as preying on some of these companies that are very weak, especially during times of COVID stress that we've seen over the last year.
And that goes a long way to explaining some of the glee that the average public has sort of expressed over this. They may not know exactly how hedge funds work. They may not know exactly how short selling works, but they see the big picture, which is that the little guy brought down hedge fund, right? And so there's a certain amount of general glee, on Main Street that goes along with that headline, even though if that doesn't tell the whole story, because of what you just described, that this idea that these big hedge funds are preying on these smaller companies, right?
That's exactly right. And first and foremost, it's great that the retail market has taken such an interest into what's been occurring, but also really taking the financial freedom and power into their hands to participate in the market. Our firm really believes the more participants we have within the financial markets, the more efficiencies we'll see over the long run. In the case of GameStop, 140% of its shares outstanding, which is hard to believe, was actually sold short. So the squeeze that we are watching right now really shouldn't be surprising because we've also seen this happen in the past. Volkswagen is another great example during 2007, 2008 that had a short squeeze to almost of this magnitude. So again, the retail investors were correct on the trade. We actually had owned GameStop about 3 weeks ago in our portfolio, given some of the fundamentals that were starting to develop, and it ended up just being a little bit more of a magnitude trade than anyone thought it would be.
Right. So I'm curious, though, now that these small armchair traders have turned into a force, right, that can do what we saw what happened with GameStop, is that going to change the future of shorting stock?
I think it will change the future of, shorting stocks, mostly because we've seen more liquidity come into the market via the retail side. Selling short is extremely challenging. It is a very hard game. But I think what we've seen is that selling short as just an entire business model has changed, which now we see more companies using it as more of a selective basis instead of just one particular strategy. But it's something that we just need to be mindful of going forward, especially as retail investors are looking to continue this capitalization of GameStop. We've seen AMC, BlackBerry, and so forth.
Right. So is your bet that big hedge funds aren't going to put so much of their money into short trades anymore? And then will they no longer be hedge funds then if they're forced to go long more than short?
Yeah, so I think hedge funds will still exist. It's just a different dynamic model. I think a lot of them learned their lesson on how much short exposure did they have, right? One of the best portfolio construction techniques is using the ability to go long, but also go short a certain portion of your book. It's risk management 101. And a lot of the big boys felt it. Obviously, we saw some big hedge funds come in even this morning saying we're out of the short game, we're going back to the long only side. But there's so many different instruments out there, like options that really exacerbated the GameStop play, that could be used to help hedge risk instead of just going short. There's many tools at our disposal.
So let's talk a little bit about another big winner out of this entire situation, which is really Robinhood, right? I mean, Robinhood has emerged. A lot of Americans never even heard that name a few days ago. Now everybody knows what, Robinhood is. So talk about what it did when it prevented its users from buying GameStop yesterday. Talk about whether that was an okay move. And, a lot of lawmakers now in Washington are saying, hey, Robinhood shouldn't have been able to do that. But this is a private company, correct? They can set their parameters. Talk to me about what you think the future of these kind of private trading apps like Robinhood will be.
Yeah, so that's another slippery slope conversation, because Robinhood, again, pulling the plug like that really caught a lot of retail investors off guard, which we've seen. But we also have to understand that when we trade in the option markets or those derivative markets, there are maintenance requirements or cash collateral requirements, which Robinhood did not have. So we saw the story this morning where Robinhood had to go pull a $1 billion line of credit to shore up liquidity. That's a very normal occurrence, though. I don't want to make it sound like that's something that's negative, but brokerage houses need to shore up liquidity when a lot of people are trading on margin debt. And with margin debt at ultra high levels right now, with the speculative option frenzy that we saw, it was pretty obvious that the clearinghouses were going to come in and start shoring up just from a risk management technique. So while it seemed like they really were trying to discredit or disenfranchise the retail traders, I still also believe it was to protect not only Robinhood, but those retail traders, because margin requirements, they're never fun when you're on the wrong side of that trade. And this is something that has occurred in the commodities markets for a very long time, just given the nature of those investments. So we believe that Robinhood, their certain clients or their individuals, need to understand that, hey, margin requirements are part of the game. It wasn't necessarily towards just disenfranchising, even though it seemed that the rug was pulled very fast.
Right. And Andrew, before we let you go, I mean, I guess it's worth reminding people. They hear these stories and they think, wow, all this money to be made. Let me sign up for one of these accounts. Let me get into this game. But, as you pointed out, there are a lot of risks as well, correct?
That's exactly right. And this is the most important takeaways. When we start getting into those more speculative trades, the ones that make us a lot of money and we get excited about, risk and return are related. So the more return we get, the more risk we have to take. There's nothing as a risk-free investment. So looking into the nature of what is the underlying meaning of those investments, what is the capital outlay that we are required to put up, that's very important, and that's where I think Robinhood traders should really focus on as they continue to go through the financial freedom of running their own financial accounts.
And just really quickly, do you read these Reddit threads? Do you take, do you think that investors now need to start paying attention to where these people are going, where this money is going?
I think social media sentiment has been a strong force for the last decade, and it will continue to be. And we read one or two here and there. Our investment thesis doesn't necessarily trade on those, our process, but we definitely are mindful of the social media presence that has become a reckoning force within the game.
So interesting. All right. Well, Andrew Smith, thank you so much for joining us. We really appreciate you sharing your financial insight with us.
Thank you.